Google's Alphabet becomes another big technology name to get hammered after announcing blockbuster results yesterday after the bell. Why? CapEx. Google's plan to accelerate its spending to as much as 175 to 185 billion US dollars this year eclipsed stellar results yesterday after the bell. Once again, the market's response was blunt: stop spending. Elsewhere, gold and silver are under pressure again, while the euro and sterling are losing ground this morning versus a broadly bet US dollar into the European Central Bank and Bank of England policy decisions. So welcome. This is Swissquote's Daily Market Talk. It's February 5th. I'm İpek Özkardeskaya, and everything I will say in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the heavy software sell-off that was triggered on Tuesday this week by the news that Anthropic is rolling out a new tool to handle legal and research work spilled to the broader technology sector yesterday. Big technology companies and semiconductors all pulled back aggressively, sending the Nasdaq 100 index below two key levels: its 100-day moving average and also the psychological 25,000 support. AMD, that announced better than expected earnings the night before, fell 17% yesterday. Yes, 17% to the $200 support. Nvidia fell 3.41%, while Google retreated more than 2% into its own earnings and fell as much as 7% at one point in the after-hours trading right after the earnings were announced before retracing these losses. But the earnings were great. The company made over 113 billion US dollars in revenue. That's roughly 2.5 billion more than penciled in by analysts. Its cloud business grew 48%. Far more than forecasted by analysts, as a confirmation that AI and cloud services don't only grow strongly, but even stronger than the sky-high expectations from analysts. So what went wrong yesterday? The company said it will accelerate its CapEx spending to 175 to 185 billion US dollars this year. And that's massively above the 120 billion US dollar spending expected by analysts. And that immediately casts shadow on the amazing results that it just announced. Voila. So the market continues to scream, stop spending, and big technology continues to respond. But I need to spend more to make sure that I don't run out of capacity with the avalanche of AI demand and computing needs that come along. But at the end of the day, investors will say the last word. If they want their big technology darlings to slow spending, and they express this feeling by sending their stock prices into a free fall, well, the spending will have to slow no matter the expectations that the computing needs will reach yottafop in next 5 years, as says Lisa Su. So I think we're collecting quite important clues at the moment for what's next. Meta, Microsoft, and Google, they all announced results so far, and I'm not counting Apple among the AI plays, and they all printed better than expected quarterly results. But they all pledged to invest more as well. Much more. On the revenue front, the AI revenue and revenue channels are notable for Meta and Google, especially for Google actually, that offers TPU chips right now, which seems to be boosting its cloud demand. It has Waymo, the self-driving car unit that is now valued at 126 billion US dollars. And it has a major partnership with Apple right now to put its Gemini on iPhones to reach around 2.5 billion devices around the world. But when it's no, it is no. Investors don't agree with the current spending from the big technology companies. So my guess is that if these earnings and the improved earnings expectations on the back of these strong earnings cannot help lift sentiment, it will be hard to prevent a sell-off in the technology space, and a 10 to 20% pullback in Nasdaq 100, for example, looks plausible. That would bring the index somewhere within the 20,000 to 23,500 range. The S&P 500, on the other hand, could outperform, benefiting from rotation to value names. The value stocks have indeed been outperforming growth stocks by most since 2022, and the S&P 500's equal weighted index is catching up with the normal weighted technology heavy version. And the potential rate cuts from the Federal Reserve could further support the rotation trade, rotation toward value names, towards cyclicals, and also non-US names as well. Now, speaking of interest rate cuts, yesterday's ADP report from the United States came in weak and weaker than expected. The big US economy added only 22,000 new private jobs in February. A very small amount indeed. It's almost laughable when you think that the US GDP grew more than 4% during last quarter. So relative to that strong growth number, 22,000 job additions for the entire US economy looks quite rikiki, as would say the French. The services PMI, on the other hand, came in better than expected, but the US 2-year yield eased, suggesting that the soft jobs number from ADP yesterday tilted the balance toward the Federal Reserve dose yesterday rather than the hawks. Now, this notable divergence between the US growth and its labor data comes basically from the fact that a big chunk of the US growth is now fueled by AI investments. You know, the big technology spending that we just talked about, that's what's boosting US GDP right now and will continue to do so, judging by the latest commitments. But the sector doesn't necessarily create jobs at the moment. On the contrary, it helps companies cut jobs to cut costs because one person becomes capable of doing the job of a team with the help of these AI bots. Add to that the weakness that probably comes from trade disruptions, while the jobs outlook is not sunny. The Fed has pointed at a stabilizing jobs market at its latest meeting, remember? But if job additions remain this weak, well, the Federal Reserve will have to play the rate cut card, even more so as the Fed's new leadership under Mr. Kevin Warsh will likely refrain from ballooning the Federal Reserve's balance sheet further and will likely justify the rate cuts by the idea that AI will increase productivity and ease inflationary pressures while putting more jobs at jeopardy. So activity on Fed funds futures gives around 60% chance for a 25 basis point rate cut from the Federal Reserve in June this year, and that's 5% more than before the ADP data released yesterday. And if the Fed bets turn more dovish from now, and justified, it would continue to press the US dollar lower and the majors higher. Interestingly though, the US dollar index is not following the US 2-year yield lower since yesterday. It is, on the contrary, gaining fuel against the euro and sterling this morning. Gold also returns below the $5,000 psychological mark as an answer to my yesterday's worry that it may not be able to do its protection job in a portfolio because it's moving in tandem with risky technology stocks right now. Silver is down also below the $80 per ounce level this morning, and the white metal is testing a major Fibonacci support to its long-term bullish trend. And the euro dollar sees support near the 117.85 mark at the time I'm talking here into the European Central Bank verdict, while cable retreats to the lowest levels in 2 weeks ahead of the Bank of England's decision. Now, both central banks are expected to keep their interest rates unchanged today, so the game will be played on the guidance field. The recent data pointed at slowing PMI numbers for the euro area economies and a falling inflation in January. The euro area inflation fell to 1.7% below the European Central Bank's policy target in January, according to the preliminary reports, while core inflation eased to 2.2% from 2.3% printed a month earlier. So the slower growth and tame inflation could open the door for a dovish shift in European Central Bank expectations, also provided that the European Central Bank will continue to justify its monetary policy decisions and outlook by economic data. And if that's the case, the euro-dollar bulls will be forced to abandon the 1.20 target in favor of a retreat toward the 1.15 level in the coming months. The Bank of England, on the other hand, should continue to weigh in still sticky inflation, the heavy fiscal policy, and the bleak outlook. But in both cases, one thing that could keep the euro and sterling bulls on the battlefield is the weak US dollar appetite and a relatively more dovish Federal Reserve compared to the ECB and the Bank of England. This morning, however, traders have a better appetite for the greenback. So let's see how the day unfolds. But this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.